Hello friends, in our earlier lectures we have discussed about the scope of the standard. Then we discussed about how to determine cost, what can be included in cost of inventory, what cannot be included in cost of inventory. In our third lecture we discussed the various cost formulas which can be used to attribute cost to various items of inventory. We learned about various methods, shortcuts available to arrive at cost of inventories. Now in this lecture we are going to discuss about what is the meaning of NRV, how to determine NRV. We are also going to learn situations where we are going to write down the inventory below its cost. We will also discuss situations where the inventory which has been written down earlier can be increased, the value of the inventory can be increased, or we will deal about write back of inventory, and then we will also learn about the various disclosures as required by the standard. Okay, so let us go ahead. On the first issue we are going to discuss in this lecture, we are going to first of all discuss para 28 to 33 of the standard. We'll start with what is NRV. The general meaning of NRV is, NRV full form is net realizable value. It is the net amount which the entity expects to realize from the sale of inventory in the ordinary course of business. So on balance sheet date, if I have some unsold goods, I have to estimate in normal course of business when I sell the inventory, net amount what am I going to get. Why am I saying net amount? Because even to sell the goods we might have to incur some cost out of our pocket. So I want to determine net, that is income minus expense. What is the net amount I am going to realize when I sell the inventory in the ordinary course of business. To determine NRV we have a formula: estimated selling price in the ordinary course of business minus estimated cost of completion minus estimated cost of making the sale. See, this point, estimated cost of completion, is relevant only for semi-finished goods. Goods which are not saleable in current condition, that means the goods can be sold only after completion. For determining the NRV of such goods, that is semi-finished goods which do not have selling price in its current condition, only for those goods we are going to include estimated cost of completion for arriving at NRV. If you have a stock of finished goods in your hand, estimated cost of completion for those stock would be 0. Now what is estimated cost of making the sale? Even to sell the inventory we have to incur some direct selling expenditure. We might have to pay some commission to a broker or an agent for the purpose of getting the goods sold. We would have to incur some direct selling expenses for getting the goods sold. So those costs also have to be subtracted to arrive at net realizable value. So what is net realizable value? It is a net amount. That means what is that I am going to get when I sell the inventory in my ordinary course of business, subtract what is the cost I have to incur to get that amount after sale. That net amount is going to be considered as net realizable value. So we take the estimated selling price, subtract estimated cost of completion, and subtract estimated cost of making the sale to arrive at net realizable value. So this is the amount which I expect to realize in the ordinary course of business when I sell the inventory. Now, there can be situations where NRV is less than cost. I hope you remember, as per para 9, unsold stock on balance sheet date has to be valued at cost or NRV, whichever is lower. That means if cost is lower than NRV, that means we are going to recover more than cost. Net realizable value is more than cost. In such case, inventory will be valued at cost. There can be another situation where NRV is below cost. That means the amount recoverable from sale of the asset is below the carrying amount or the cost. In such cases, the value of the inventory would have to be written down. Okay. Before I go to this point, you have to remember a very simple point, that an asset cannot be stated in our books at a value higher than its cost. We can say an asset cannot be carried in our books at a value higher than the recoverable amount. I will give you an example to understand this point. Suppose I have incurred 100 rupees to buy an asset, but I know that when I sell it, I am going to get only 80 rupees. It is not correct for me to show the asset at 100 rupees, because I know that when I sell the asset I am going to recover only 80. So an asset cannot be shown at cost where the recoverable amount is below cost. If recoverable amount is below cost, the value of the asset has to be written down. I know that I have incurred cost, but I am going to recover less than that amount. In such case, I have to write down the value of the asset. So that principle is applied here. So there can be situations where net realizable value, that is a recoverable amount on the sale of the inventory, is less than cost. We call it as write down, or we provide for fall in value of inventory. Now, when will the net realizable value, when will the recoverable amount of inventory be below its cost? The situations are inventory is damaged or inventory has become obsolete. In such cases, definitely I know that the recoverable amount is going to be below cost. Then decline in selling price. The market price of the product has reduced. Now I know that I have spent more for producing the product, and because of fall in selling price, I know that I will not be able to recover my cost. So this can also be a situation where NRV is below cost. Increase in estimated cost of completion, increase in estimated cost of making the sale. You can see this equation here. If this increases, NRV is going to reduce. If you keep the estimated selling price constant, and if estimated cost of completion has increased, definitely the NRV is going to reduce. If estimated cost of making the sale has also increased, automatically NRV is going to reduce. So in these situations, NRV will be below cost. That means recoverable amount is below cost. If recoverable amount is below cost, you cannot show the inventory at cost. You have to write down the value of inventory. So you have to recognize a loss, or you have to provide for fall in value of the inventory. Okay. Next, decline in selling price after balance sheet date. So a question can arise. Suppose on balance sheet date, I had good market price. The selling price was good. But after balance sheet date, the market price has started declining. Should I consider that decline in prices after balance sheet date for calculation of NRV? Now the answer here is, if the product is exchange traded commodity, that means the price are available from an exchange where you can deal with this commodity. Now on balance sheet date, selling price was good. The NRV was not below cost. But later on, after a month or after 2 months, because of fall in demand of the product, the price on the exchange has reduced. Now in this case, we cannot consider this decline in price of raw material for decline in price of the product for estimation of NRV. Okay, because the decline has nothing to do with condition which was existing on the balance sheet date. The other example is, suppose on the balance sheet date itself, I know that the inventory which I am having is a slow moving product. The market price is already reduced. I know that it is doubtful whether my cost will be recovered by selling the asset. So the NRV was already under pressure on balance sheet date, and after a month from balance sheet date, we have already sold the inventory below cost. That means we have sold the inventory at a loss. In such cases, sale of inventory below cost after balance sheet date gives evidence to you about the NRV which was there on the balance sheet date. On the balance sheet date, we know that the stock was slow moving. We knew that, we had doubts that we will not be able to recover the cost when we sell the goods. And after a month, our doubts have been confirmed. The goods have been sold actually below cost, and we have made the sale at a loss. In such cases, this information should be considered for arriving at NRV on balance sheet date. That means on balance sheet date, we should take NRV at below cost, and we have to provide for a loss. Is it clear? So this is how sometimes decline in selling price after balance sheet date can also have an impact on estimation of NRV on balance sheet date. See, generally the NRV is estimated based on selling price estimated on balance sheet date. But in certain circumstances, when inventory has actually been sold after balance sheet date, that price have to be considered for the purpose of estimation of the NRV. So this is what we have discussed in this situation. Okay. So the point is very simple here. Okay, just make a chart here. This is balance sheet date. On balance sheet date, I know that the goods are slow moving. I know that NRV is going to be below cost. I have a doubt. The management estimates that the recoverable amount is going to be below cost. After a month, the goods are sold at loss. Now, there is already a condition existing on balance sheet date. The goods are slow moving. I have a doubt whether the recoverable amount will be equal to carrying amount. After 1 month, my doubts have been confirmed. Goods have been sold at a loss. Now this information has to be considered for the purpose of arriving at NRV on this date. So on balance sheet date, when we are determining the NRV, we can definitely take the actual sale price at which we have sold the goods after a month for the purpose of writing down the value of inventory on the balance sheet date. Okay. So now let us continue. So we can summarize before we go to the next situation. When the net realizable value on the balance sheet date is below cost, you have to provide for a loss. If the net realizable value is above cost, we are going to ignore the increase in value of the inventory. We are not going to provide for any losses. We are not going to recognize the increase as an income. But when NRV is below cost, definitely yes, we have to recognize the fall in value of the asset. Okay. Let us come to the next topic. How is the comparison of cost and NRV done? See, the standard says we have to show inventory at lower of cost and NRV. So we have to compare cost and NRV of inventory. So how to do comparison? So for this purpose, the standard says you have to compare item by item basis, or some situations you can adopt group basis, but the standard says comparison based on classification is not allowed. That means you cannot compare total cost of all finished goods with total NRV of all finished goods, total cost of all work in progress with total NRV of all work in progress, total cost of all raw material with total NRV of raw material. You cannot do comparison based on classification. Either you can compare based on item or on the basis of group. Now when can you compare item by item basis or group basis? Let us suppose there are 4 types of inventory in our godown, A, B, C, D. Now if all these 4 types of inventory have the same use, they have similar use, they are used in the same product line, they cannot be evaluated separately. That means their nature is similar and they are used in the same product line. In such cases, we can group all of them and then compare total cost of all these 4 goods with total NRV of all these 4 goods for the purpose of computation of, for the purpose of comparison of cost and NRV. But the answer comes, nature of raw material A, nature of raw material B is different. Use of this and use of this is different. They are of different use, they are not similar, they are not used in the same product line, and they can be evaluated separately. In such cases, we have to adopt item by item basis. So if the goods are of similar use, they are used in the same product line, they cannot be evaluated separately, then we can group them and then compare cost and NRV. If they are dissimilar in use, if they are used in dissimilar product lines, they can be evaluated separately, then we have to follow item by item basis of comparison. Okay, so this is how we have to compare, but we cannot compare based on classification. Inventory held to satisfy firm sales contract. Now sometimes you have to consider the purpose for which we are holding inventory. Now there is a situation here. If you are holding inventory to satisfy a firm sales contract, that means I already have a contract to supply goods. I am holding some inventory, I already have a contract under which I can supply my goods. So how to value such inventory which is held to satisfy a firm sales contract? The standard says NRV of such stock which is held to satisfy firm sales contract should be based on contract price. It should not be based on market price. Okay, so there is an example here. I have a closing stock of 10,000 units on balance sheet date. Cost per unit is 500 rupees. Market price is 400 rupees. So if you compare the cost, this is the cost I have incurred to buy these 10,000 units, but NRV is only 400. That means there is a loss. When I sell the inventory, I am going to get a loss of 100 rupees per unit. Now the question arises, should I recognize the loss on all these 10,000 units? No, wait, let us go through the some more facts which are given in the example. There is a contract from the government to supply 5,000 units at 600 rupees per unit. So I have a contract from the government. The contract says that I have to supply 5,000 units to the government at 600 rupees per unit. Now if you can observe here, I have a stock of 10,000 units, but out of those 10,000 units, 5,000 units are held to satisfy a firm sales contract which I have in my hand. So for these 5,000 units, the NRV will be based on the contract price. But for the remaining 5,000 units, the contract price will be based on the market prices. So the inventory valuation would be like this. 10,000 units held under firm contract 5,000, NRV would be based on 600. So now you have to compare selling price 600, cost price 500. So whichever is lower, so you will take 500. The remaining 5,000 units, for these 5,000 units I don't have any firm sales contract. NRV of these 5,000 units where I don't have a firm sales contract would be based on the market price. Market price, NRV is 400, cost is 500, whichever is less, this will be 400 rupees. That means on this stock where I have a firm sales contract, I am not going to recognize any decline in value of the units of the inventory. Actually there is a loss, 500 is the cost, but selling price, market price only 400. But in the case of this stock, 5,000 units, I can supply to the government at 600 rupees per unit. I can make a profit of 100 rupees still. 600 rupees is my selling price, 500 rupees is my cost price. So here I am not going to get any loss. So this inventory will be valued at cost. But the remaining stock where I don't have any firm sales contract, for this stock NRV would be based on market price. So estimate selling price is 400 and cost price is 500. Whichever is lower, I have to value this inventory at 400 rupees. So the value of inventory would be 25 lakh and 20 lakh, the total value will be 45 lakh. So we are going to book a loss now. The total cost of inventory was 10,000 into 550 lakh, but closing stock is valued at 45 lakh. So I have to provide for a loss of 5 lakh rupees in my books of account. So when you are holding inventory to satisfy a firm sales contract, so the stock which is held to satisfy firm sales contract, its NRV would be based on contract price, and stock which is held in excess of the quantity required to satisfy the firm sales contract, it would be based on general selling prices. So this is what the standard has to say. Next, let us go to inventory of raw material. How to value inventory of raw material? See, there can be situations where a company is holding a huge quantity of stock of raw material, and let us suppose the company has purchased some raw material at the rate of 10 rupees per kg, but on balance sheet date the same raw material is now available in the market at only 8 rupees per kg. So this is an indication that the recoverable amount of the raw material has reduced. I have purchased it for 10 rupees, now it is available for 8 rupees, so there is a fall in value of raw material. A question arises, if I am holding some unused stock of raw material, should I write down the value of raw material? Should I recognize a loss? What the standard says is, if finished goods in which this raw material is going to be used is sold at cost or above cost, ignore fall in value of raw material, do not provide for any loss. But if finished goods is going to be sold below cost, below the cost of production, that means I will not be able to recover what cost I am incurring for manufacturing the finished goods. In such cases, I have to recognize the fall in value of raw material and I have to book a loss. So again, I summarize this. I have purchased some raw material, let us say I have 1 lakh kgs of raw material which I have purchased for 10 rupees per kg. On balance sheet date, this raw material is unused. Suppose on balance sheet date, the price of the raw material has reduced to 8 rupees. That means there is a reduction of 2 rupees in price. Should I provide for the loss? The standard says, ask the question, if the finished goods in which this raw material is going to be used is sold at cost or above cost, we are going to ignore the fall in value of the raw material, because however, even if I include 10 rupees as part of cost of production, I am going to recover it. So I am not going to get a loss. That is why I have to ignore the fall in value of raw material. But when the finished good is sold below cost, I know that I have a doubt whether I will be able to recover the raw material cost which I have incurred in manufacturing the finished goods. In such cases, fall in value of raw material has to be recognized. Now, in such a case, how do you calculate the value of raw material? Standard says, again compare cost with NRV. Estimate what was the cost of raw material compared with NRV of the raw material. NRV of raw material will now be determined based on replacement cost of raw material. So to replace the same quantity of raw material, what is the cost you have to incur? That you have to estimate. That will become the NRV of raw material. If NRV of raw material is below cost, we would have to provide for a loss. So raw material can be valued at below cost only if the finished goods in which you are going to use it is going to be sold at cost, is going to be sold below cost. If it is sold at cost or above cost, then no question of providing any losses. Now, other important point is, I have purchased 10,000 kgs of raw material and the value of the raw material has reduced. If the value of the raw material has not reduced, in such case I need not provide for any losses. Okay, so I hope you are able to understand. So valuation of raw material depends upon valuation of finished good. Let's now come to the next part. Review of NRV of inventory previously written down. So earlier we have seen situations where the value of the raw material might be written down below its cost. That means you would have provided some losses. Now what the standard says is, during this year, if you have written down the inventory, if you have provided for losses in value of inventory, and in the next year the inventory is still in hand, it is not yet sold. This year we have provided for a loss, inventory is not yet sold in the next year. The standard says we have to again re-estimate the NRV of this inventory in the subsequent periods as well. And you may find that due to improvement in economic circumstances, due to increase in selling prices, you may come to a conclusion that the value of, we can say, the loss might have reversed, or we can say the NRV of the inventory might have increased. So there can be situations where we have to reverse the write down as well, due to change in economic circumstances, due to increase in selling prices, due to increase in demand for the product. There can be a reversal of loss which we have already recognized. So what the standard says is, reversals can be written back, but the write back cannot be more than the write off. Let us suppose in the last accounting period, cost of inventory was 100, its NRV was 80, we have provided for a loss of 20. So in our books now the inventory is carried at only 80 rupees. In the next year, inventory was not yet sold, you estimate the NRV again, NRV comes at 110 rupees now. The selling price has increased in next year. Carrying amount is 80, but now NRV in the next year has become 110. That means there is an increase of 30 rupees. Now can I write back 30 rupees? The answer is no. Earlier you have written off 20. Out of this 30 increase in value of the inventory, you can write back only 20 rupees. So the write back cannot be more than the earlier write off. That is what the standard has to say. Next, treatment of inventory in P&L account. How do we deal with inventory in P&L account? When inventory is sold, the carrying amount is recognized as expense. So whenever the inventory is sold, its carrying amount will be debited to P&L account as an expense. When inventory is written down, when NRV is below the cost, you have to write down the value of the inventory, you have to provide for loss. In such cases, these are debited to the P&L account, they are recognized as an expense in the P&L account. Based on materiality, you may show it also as an exceptional item. Okay. Next, when reversal happens, there can be situations where NRV has increased. Now you want to increase the value of inventory. What standard says is, reversal of write down is an income. How should you recognize that income? This income should be recognized in P&L account by reducing the related inventory expense. So whatever item you are showing as expense in P&L account related to inventory. So you show cost of goods sold as expense in inventory. So whatever expense you are showing relating to inventory in the P&L account, that expense has to be reduced to recognize the reversal of write down. So reversal of write down should be recognized by reducing the expense related to inventory. Write down should be recognized as an expense. When inventory is sold, carrying amount should be recognized as an expense. Okay. Now let us come to the next part. When inventory is consumed in construction of an asset. Sometimes the company will construct its own asset. So when you are constructing your own asset, the value of the raw material which has been consumed, the value of the inventory which has been consumed is going to be recognized as part of cost of the asset. That means it will be capitalized, it will not be debited to P&L account. Now we come to the last part, disclosures required by the standard. As per the standard, we are required to disclose the accounting policy. What is accounting policy? How are you measuring inventory? Is it at cost? What is the accounting policy you are following? And the related cost formulas. Which cost formula you are following? Whether you are following FIFO method, weighted average price method, retail price method, which cost formulas you have used, that also has to be disclosed. Then total carrying amount with classification, you have to disclose the total carrying amount of the inventory along with classification. In our first lecture we discussed, as per para 37 of the standard, there can be various classification. Inventory of raw material, we call it as inventory of material, production supplies, finished goods, stock in trade, merchandise, and also inventory of work in progress. So you have to give major classification as well. Breakup of carrying amount has to be given. Amount of inventory is recognized as an expense. So during the year, what is the value of inventory which has been recognized as expense in the P&L account? That also has to be disclosed. Write down of inventory recognized as an expense. During the year, if the NRV of a particular inventory is below its cost, it is written down, that loss is debited to P&L account. How much is recognized as an expense relating to write down has to be disclosed. Similarly, reversals. Reversals you recognize as a reduction in expense. So how much of the reversal has been recognized as reduction in expense also has to be disclosed as part of notes to account. Circumstances relating to reversal. So which you have to describe the circumstances in which you have reversed the write downs earlier. Then carrying amount of inventory pledged as security. So if inventory has been pledged as security for loans taken by the company, so what is the carrying amount of inventory that has been pledged also has to be disclosed as part of notes to account. The last is carrying amount of inventory is carried at fair value less cost to sell. Suppose if you are a commodity trader broker, as per the standard, you are going to initially recognize inventory in your books at fair value less cost to sell. Subsequently also you are going to value the inventory at fair value less cost to sell. So out of a total inventory, what is the inventory? What is the amount relating to inventory which is carried at fair value less cost to sell? So these are the disclosure requirements as per the standard. Thanks a lot.